Mark Zandi, the chief economist at Moody's, has just stated that he thinks we're on the verge of a recession. So they're all come around to my point of view, and the reason for that is that money dominates.
Okay.
I'm not surprised by this, because if you get a big change in the money supply, with a lag, it works into the economy, and it changes the rate of growth in the real economy, and it also changes the inflation rate.
Welcome back to Metals and Miners. I'm your host, Gary Bohm. Today we're diving into the dynamic world of economics, markets, and global financial trends. I'm thrilled to introduce Steve Hanke, professor of applied economics at Johns Hopkins University, and the former senior economist on President Ronald Reagan's Council of Economic Advisors. Steve, it's an honor to have you back on Metals and Miners. Welcome to the show.
Great to be with you, Gary.
All right, Steve, you're someone who's able to cut through the fog and confusion of monetary policy, economic strategy, and currency market headwinds. What would you say that the people tuning in to our conversation today will walk away with after listening to our discussion?
Money dominates.
Money dominates. All right, do you want to expand on that?
Yeah, money. When I'm talking about that, I mean the stock of money and the rate of growth in the money supply, broadly measured. In the U.S., the broadest measure the Fed puts out is M2. However, you can obtain really, I think, a superior measure from the Center for Financial Stability in New York, where I'm a special counselor, and that goes out to M4, and it's also measured in what they call divisia. So the divisia measure, instead of just adding everything in a simple sum up in terms of the components of the various measures of money supply, M1, M2, M3, and M4, it puts weights on those elements. Instead of assuming each element has 100% weight, the divisia puts a weight on those, and the weight is determined by how much moneyness is in the component that you're adding in. For example, M4 actually goes all the way out to T-bills are included in that, but the weights are not so great because the moneyness isn't as great as cash, for example, or checking accounts or short-term time deposits and things like that. So that's if money is important. In short, Gary, if you think money dominates, which I do, because I embrace the quantity theory of money. The quantity theory of money is the theory and model that allows you to anticipate where nominal GDP is going. And nominal GDP, of course, has only two components, and that is the real rate of growth in the economy and the inflation rate. So what more do you want? You want to know where the real economy, what the rate of growth is going to be, and you want to know what the rate of inflation is going to be. At least if you're in the metals market or currency markets or any markets for that matter. And that's why I say money dominates.
All right, so before we dive in, though, give us the cliff notes, give us a sneak peek, the trailer version. How is money dominating? Where is it going? What should we expect?
Okay, so one way to think about it is kind of the metaphor. The metaphor is that you got an engine, and the fuel going into it is money. That's what makes the engine purr. And if you start weaning it off and slowing down the rate of input of the money supply, the engine's going to start sputtering on you.
Yeah. I know. I mean, I understand that. It just from the moneyness stats, from the data that you see,
Okay.
where are you projecting?
Oh, okay, fine. So what we've had for the last 2.5, a little more than 2.5 years, the money supply, and until very recently, the stock of money actually was contracting. It was going down. Now it's up a little higher than it was in, let's say, April of 2022. That was quite a while ago. And these contractions have only occurred 4 times in the U.S. since the Fed was founded in 1913, and each one of those was followed by a recession. And in one case, 1929 to 1933, of course, we had a huge, the Great Depression. But the money supply really tanked then. It was down, I think, a little over 35%. The stock of money, huge contraction.
So are you still expecting a economic contraction here?
Yes.
Okay.
So, and by the way, now the winds are changing. Remember, a week or two ago, everyone was saying, poo-pooing the idea the economy was slowing down. We were going to have a recession. You know, I was almost the only one in that camp. Now I noticed that Mark Zandi, the chief economist at Moody's, has just stated that he thinks we're on the verge of a recession. So they're all come around to my point of view, and the reason for that is that money dominates.
Okay.
I'm not surprised by this, because if you get a big change in the money supply, with a lag, it works into the economy, and it changes the rate of growth in the real economy, and it also changes the inflation rate.
It's hard for everyone who's in the microwave economy, when they press a button, have it ready in a couple of minutes, to wait for that lag to work its way through the system. But all right, let's move on here. Gold is up 25% year to date. Silver's gained 26%. S&P 500 barely limping along at just 6%. That means precious metals are beating mainstream stocks by a factor of 4 so far this year. Do you expect the metals to market's outperformance to continue?
Yes. And the reason for that is the metals are in a bull market. The one I keep my eye on, we've talked about this before, is gold. I'm not into silver and platinum and some of the other precious metals. So I have a limited view, and the view is gold.
I got you.
Buy gold, wear diamonds. That's my motto. So
Okay.
Gold is still in a bull market. The other precious metals actually are leading gold a little bit, which suggests that there's still a lot of fuel in the tank for the precious metals to go up. And we have to talk about going up relative to they'll be going up in absolute terms, but relative to the stock market, I think they'll be going up big time, because the stock market, I have a bubble detector that I use, and the bubble detector indicates that the stock market is in a bubble. Now, the problem is it's very hard to predict if a bubble's ever going to pop, number one, or the other thing that it could do, it can either pop and things go back to some kind of a, shall we say, reasonable valuation levels, or the air can just come out of the bubble very slowly, and you reach those normal or justified valuation levels that way. So there are 2 ways that the bubble can end up: popping or just slowly letting all the gas out.
Yeah, and I think, to your point, in the 30s and with the NASDAQ in the early 2000s, that was a sharp drop. But in the late 60s, early 70s, it was more of a letting the air out slowly, and it was an elongating drop down, but very slow, a rolling over, so to speak. And we could see something very similar to that.
Exactly. So the bottom line is that the precious metals are going to go up in an absolute way, but they'll go up in a relative way even bigger time, because the relative we're measuring against as we speak here are the equity markets. And I think the equity markets are overvalued, overhyped, and overpriced, and they're in a bubble. So,
Okay.
so there you have it.
All right. I appreciate that. All right. So, Steve, central banks, they have increasingly been bypassing international gold markets to purchase domestically mined gold in local currencies. According to the World Gold Council, 19 out of the 36 surveyed central banks, they're now sourcing gold directly from small scale or artisanal domestic producers. That's up from 14 just a year ago. And an additional 4 of them, they're actively considering this approach. So central banks are shifting to local mines. We saw our own Department of Defense buy direct rare earth metals from MP Materials just recently. Competition for natural resources is clearly picking up steam. What are the implications ahead that you can see of this direct government to mines style purchasing?
Well, I think it's obviously a geopolitical thing and a supply chain thing where you said the Defense Department, is involved. Now the Defense Department, by the way, it isn't the Department of Interior or the old Bureau of Mines and that kind of thing. It's the Defense Department. They want to secure supply chains and onshore them. And related to that is gold. I mean, for example, you get a gold mine, you probably have a byproduct is antimony. So if you support if you're supporting local miners, you're not just supporting gold. Mining, there are all kinds of byproducts. The primary mine might be in one area, but there are byproducts that are related to it. So this is basically supporting local miners as a way to de-risk the global commodity supply chain, if that makes any sense.
Okay.
But it is happening big time. I mean, at the Department of Defense, I know this for a fact, by the way, because I have colleagues that were just over making presentations at the Department of Defense last Friday about what? About critical materials like niobium, like vanadium, like lithium.
Yeah, it seems like I think they're recognizing clearly, and we should be understanding this out in the marketplace, that they're recognizing that these could become bottlenecks to very important outputs that they're trying to get to. And so they're going to shore up their supply chains any which way they need to before there's no way to maybe shore it up.
And I think this is probably just the start of things in a way, because the should we say the political crowd and the bureaucratic crowd, the civil servants, they haven't been up to speed on mining or any of this thing. They're learning about this. They don't even know what, until recently they haven't even known what some of these things are.
Nor their critical importance to what they're trying to get accomplished. Right?
Yeah, right. The whole field of critical materials has been a nothing burger in political circles until very recently.
Right. Right. Okay. So let's turn over to the debt. How much of an issue do you view the $10+ trillion in debt that's maturing over the next 12 or so months and needs to be rolled over to higher rates? And how concerned are you about the growing budget deficits in the event that we have this recession you're talking about sometime in the next couple of years?
Well, I am concerned about it, concerned enough to be on the Federal Fiscal Sustainability Foundation's board of directors. And our main focus is precisely on coming up with a way to rein in the government, rein in the deficits, rein in the debt.
That doesn't seem to be a possibility.
Well, not unless you think through the thing like I've done and my colleagues have done, and that is there is a way, because you can't do it by statutory changes. In other words, or just regular day-to-day politics. It's just not going to happen. Everybody in Washington is bought off by some lobbyist of one sort or another. And what do the lobbyists want? Well, they want more freebies. They either want tax relief or more subsidies of one way or another, or more direct government purchases and whatever they happen to be peddling. So that the normal course of things is not going to rein in anything. Really, since Trump's first term, really since COVID, the thing has been completely out of control in Washington. Whether you're a Republican or Democrat, it doesn't make any difference. It's a bipartisan thing. They're all out to lunch when it comes to controlling the government. Now, the second possibility would be that you would have some statutory change to limit things. And we have had statutory changes in the past, but they're kind of band-aids that always get ripped off, and the politicos in Washington figure out some workaround arrangement to get out from under, throw the straitjacket off. Whatever the statutory straitjacket is, they figure a way to get it off. So what we're doing and proposing is that we have a constitutional convention under Article 5 of the Constitution, and we amend the U.S. Constitution to put in something like a Swiss debt break, where the Swiss debt break, of course, requires the Swiss to balance the budget.
Does that require 3/4 of the governors, or what is
the states? But they've already we already have 3/4 of them. They've already filed. The U.S. Congress has failed to act on the filings. So that
it still requires Congress though to make that determination to
Congress. Once the states propose and you get up to 3/4, the Congress is obliged to have a convention, but they haven't done so. They've ignored it. So the next step is that you got to have some attorney generals in some states that step up and sue the government, which I think will happen, and then you'll eventually have a convention, and only then you will debate it. And I would be advocating something like changing the Constitution to have a Swiss debt break put in, and that's what happened in 2001 in Switzerland.
Wow.
They voted over 90% of the Swiss in a referendum. They have referendums frequently in Switzerland, and they vote. In other words, they prefer direct democracy in Switzerland for big decisions, not representative democracy. So they have a referendum. They vote for the change. And what is the change? The change limits the growth in the government spending in Switzerland to whatever the growth rate is in the real economy. So that means that the government can't push aside the private sector in Switzerland. It can only grow maximum the rate of growth in the real economy. Now, it can grow slower than that. That's the cap. So that limits them. And then they also have to balance the budget over the intermediate term of 3 or 4 years.
Well, that's a wonderful proposition. I would love to see that come to fruition. I'm sure everyone else who's watching that would like to see austerity put in place is getting behind you, and we wish you good luck in getting this off the ground and seeing this come to fruition. Let's move over to the labor market here. Steve, profitability is improving despite labor market weakness. According to FactSet, 82% of S&P 500 companies have exceeded Wall Street earnings estimates in the second quarter. That's higher than the 1, 5, and 10-year averages. Revenue beats, they're also significantly elevated, with 79% of firms surpassing forecasts. Earnings growth stands at 10.3% versus the same quarter last year. But here's the but. Labor market data shows deterioration, not strength. The July jobs report revealed weaker than expected employment growth in the second quarter. Both May and June, as we all know, were revised downward, and July itself fell below the consensus. So these points, they all suggest that productivity gains are being achieved without corresponding increases in labor demand. In other words, firms are maintaining or expanding profit margins while reducing reliance on human capital. The traditional model that links GDP growth to job creation, apparently, it's really maybe no longer dependable. So the current environment shows that output and profitability can improve even as employment conditions soften. What are the implications here moving forward of that?
Well, that's a good thing in terms of the aggregate overall economy. But remember, and what you just went through was good news. I mean, beating expectations on earnings, that's great, and revenue, that's great. So top line is plus, and margins are plus, but remember, money dominates. So what do I anticipate? I anticipate the economy is going to keep slowing down, which, by the way, it did in the first half of this year. If you look at the first quarter and second quarter, put them together for the first half of the year, it was quite a bit weaker than it was in 2024. And I think it will continue to slow for the reasons I gave you earlier about the slow growth in the money supply. And what does that mean? That means from a cyclical point of view, maybe the good news is over, and these top line revenue numbers are going to come in low, and profits will come in low. I think profits will probably end the year it's virtually zero rate of growth.
Do you see an issue though where in the past it took more human capital typically to generate higher profit margins, revenues, earnings? Now it appears that that's not the case. Do you see potential or looming challenges within the economy for employment on the horizon?
Well, looking at the employment part of the thing, it appears that AI, which I don't buy all the hype on AI will improve productivity. But all the studies show, the serious studies at MIT, for example, show that it's a marginal improvement. It's not an earth-shaking thing that changes the whole regime of everything. So that's good. We'll get probably a little uptick in productivity, but where that comes in are entrance into the job market. That's where the weakness is starting to show up. You read one story after another about new college graduates having trouble finding a job in the labor market. Now, the reason for that, a lot of these entry-level jobs, whether that's college or junior college or even high school in particular, you get a high school degree, but you get into some clerical thing, and the clerical thing can be taken over by AI, so the job is gone. So most of these AI things, by the way, are very repetitious, shall we say, kind of clerical type things. That it's like a robot. Where do robotics come into play? Well, it's kind of the routine kind of stuff. You can get a robot now and train the robot or program the robot. You don't train them, you program them, and they take over those. So there is erosion in some of these sectors, and it is showing up in the job market, and of course the politics of that are interesting because young people can rebel.
So let me ask you this. So in the past, it was a function of GDP and corporate profitability going higher, and along with that, well, we'll do it this way, was unemployment, was dropping correspondingly. If we move into a period now where the employment trends change, so we have improved corporate profitability, improved GDP. I know where you stand moving forward with M2, but I'm just saying, if we end up moving forward with improved GDP and improved corporate profitability, but at the same time, employment trends are no longer trending downwards, they're trending higher because of AI or other technological advances that are, doing some of those jobs for the humans. What are the implications there?
Well, okay, so what you're talking about now are secular changes over long periods of time, and of course the classic one is, and I know all about this because I grew up in Iowa, farm country, and what's happened to agriculture in the last 100 years? You've had massive increases in productivity, and almost no one works on the farm anymore. I mean, a couple of years ago, I was out in Iowa. I hadn't been there for a long time, and it's just driving on the interstate. It was obvious that everything had changed from when I was a boy. You don't even see any barns anymore. You don't see any livestock out around a barn. There are no barns. You see no livestock. They're in these big centers, where they're on an industrial basis, so to speak. And the same with chickens and all the rest of it, or people in the field. I mean, what do you see? How are they picking corn now? They're not picking it by hand, and they're not picking it with a corn picker. They're picking it with a combine. Some of these guys, some of my old buddies I went to high school with, they're using 12-row combines and shelling the corn and everything all in the combine. They're not picking the corn and then putting it into a sheller. They're doing it all in one thing. And by the way, those combines, they're running about, one of my friends just bought one at about $1.5 million.
Wow.
But the productivity, it's the productivity thing. You just don't have any people. It doesn't require.
So essentially, what you're saying is what came to farming over the last 4, 5, 6 decades may be coming to the office place.
It'll come to certain sectors in the economy. Yes, that's the easiest way to think about it.
Yeah,
because the biggest technological change we had, and the revolution that we had over the last 100 years, it is in agriculture. Everyone was working in agriculture 100 years ago.
Well, I think the logical follow-up to that then is do you see secularly a higher unemployment rate? Maybe in the 5, 6, 7% range.
Not necessarily, because what happened to the guy who was the hired man or the on the farm? They go into something else.
Okay, so that's what you foresee. That's what you expect.
It's very dynamic. Economics is all about incentives. So if the wages and jobs aren't in a sector that's being taken over with robots and AI and so forth, what do? Well, you go to money dominates. You go to where the money is. Where
money dominates. Do you have a book yet titled "Money Dominates"? Because if you don't, that needs to be your next book.
I have a book that you should put up that is related to all this, and it came out. Wiley released it on May 6th. I wrote it with Matt Sekurki. It's called "Making Money Work."
Send me a book copy, and I'll put it up on this video.
I'll send you everything you need, but
okay,
and everything your viewers need on the quantity theory of money and making money work and so forth it's all in there.
Okay, all right. So Steve, Staying on this AI theme for a moment, there's a relentless race for AI capacity and the energy to power it. According to analysts and experts alike, America needs to find an extra 45 gigawatts for its data farms. That's the equivalent to about 10% of current U.S. generation capacity or 23 Hoover dams. What what areas do you think will benefit here from this build out, this explosion? Where are the bottlenecks? Is it the metals and the minerals? And where do you see some of these major risk points being?
Well, I think the big thing that's going to change is that we're going to go nuclear. So you can again at the margin that's going to be big, and that's a big change because that space was kind of frozen. But these small and medium-sized reactors, the technology has improved. They're very safe, and the fuel for that is MOX, capital M, capital O, capital X. So that's the space. In the commodity space, that's where you want to be in MOX.
Okay. All right. Let's discuss the U.S. consumer at the bottom of the K. All right. The bottom 70% or so of consumers. 50% of people currently who make about $250,000 are reporting that they're living paycheck to paycheck. 62% with salaries over $300,000 are struggling with credit card debt. Housing defaults are now at their highest since 2011. Student loan repayment has just started again as of August 1st. Doge austerity, that's not a thing anymore. There's been a doubling down on deficit spending. The cost of living is staying where it's at or going higher. How much more can the bottom 60 to 70% of consumers take?
Well, again, looking at the cyclical thing, you have to, forget the hype coming out of Washington and out of the White House, because as the economy slows down, you have to ask the question, well, why is it slowing down? One reason is something that's baked in the cake, has nothing to do with Washington, and that's money. And we already went through that factor. But then there's another thing going on, and that is you have this huge regime change going on in Washington with the trade war and tariffs, and of course that's really the monkey on the back of the whole thing, and that I think is a house of cards, because the economics of a tariff war are just rubbish. I mean, you don't get any economist over on the side of a trade war. I don't care where their political alignment is. You have a de minimis number. The yes people around Trump, yeah, they're all for it. Think it's great. It's going to be a complete disaster, and the economic premise for it is based on quicksand. Now, the other premise, the legal premise for the trade war and the reciprocal trade tariffs, that's probably also on quicksand. That is in the federal appeals court right now, because the justification, the premise for it is what? That we're in a national emergency because we have a trade deficit. And I don't think the courts are going to uphold this thing. So I think all of this is a house of cards that will collapse.
Okay, so let's say we get the recession that you're expecting. I'm assuming that would be a somewhat deflationary event. People will be out of work, et cetera. With where the consumer at the bottom of the K is already standing, if that kind of pain is coming, how much trouble are we looking at?
I think we're looking at potentially quite a bit of trouble, and instability, political instability, and we have what we have in the White House. And the opposition seems to be completely befuddled and without a message. They're out there in the weeds, lost someplace. You don't even hear from them. And remember, we have other geopolitical things going on. We have this war in Ukraine. Trump's a very mercurial personality, and with mercurial personalities, they can shake your hand in the morning and stab you in the back at night. You don't know what the hell they're going to do.
Let's focus. Let's hone in a little bit on the trouble, though. So we have trouble. We'll see the unemployment rate go up. Maybe the average aggregate amount of 3.2% during a recession. That'll put a lot of people out of work. That people are already struggling with their personal budgets. That means we're looking at potential bankruptcies, foreclosures, et cetera. You're talking about social unrest on whatever level that might look like, but we've seen that before in the last decade plus. Would you expect the Fed to come in and print? Would you expect there to be some kind of stimulus checks to help out these folks? What would you expect to take place here moving forward with the trouble that you're expecting?
Well, it's very hard to predict. I think the Fed, given the last episode, the COVID episode, when they exploded the money supply, and at one point, after COVID hit, the money supply was growing at over 17% per year. That's the highest rate that it's ever grown since the Fed was founded in 1913. So I think they'll be very reluctant to do that as an institution. However, you don't know. I mean, maybe there'll be enough resignations on the board of governors and replacements by Trump with new people or more yes people. So we don't know. That's an uncertain. We really don't know. But that's one possibility. Now, the other possibility, you said, well, goose the government spending, and the problem with that is that we're already maxed out. We've got a budget deficit, running, probably going to run around 7% or something like that. And if you goose the deficit and increase it and double down, what happens, it isn't what happens in economic textbooks. You don't get a Keynesian stimulus and a positive Keynesian multiplier. You get a negative Keynesian multiplier, and if you say you're going to stimulate with a bigger deficit, you actually slow things down with a negative multiplier. So the setup, your scenario of higher rates of unemployment, more pain, and you were talking about lower middle incomes last, and you said 250 grand a year.
No, well, I wasn't correlating those two things together. But look, to summarize, and this wasn't my picture, this was you talking about trouble. But to summarize, the Fed's in a box, it seems like. Yes. They don't want to print. They don't want to, because of what took place after the pandemic. The government's in a box because of the deficit spending and the budget deficits, et cetera. And not everybody, but the bottom of the K, the 70% of the consumers, they're in a box because their budgets are stretched to the max. They're loaded up with debt. So if we stay in this neutral position,
one thing we didn't mention too, with the stock market coming down under that scenario, the bubble, the air coming out of the bubble, one way or another, that hits people with not only their retirement accounts. Okay, but it also hits the very rich.
Yeah.
And remember, the very rich became very rich after the Fed goosed the money supply. In January of 2020, billionaires' wealth as a percent of GDP in the United States was 14.1%. Today, it's 21.7%. Now, why? Why did you have that huge increase in the wealth by the billionaires? Well, who owns all the assets that went up and were inflated? Real estate went up, land went up, the stock market went up, gold went up. If you owned assets, you made out like a bandit under this inflationary surge that was caused by the Fed increasing the money supply at a rapid rate. Money dominates.
So here's what everyone wants to know, though. So let's say we do have this bubble pop, and now the rich are kind of in a the negative wealth effect, the reverse wealth effect, that puts them in a box to some degree. They're not going to spend quite the same.
Exactly.
So now we have everybody's in a box. Everybody's in a box. We got things that are happening, troubles happening. What is going to take place to alleviate some of this pain?
Okay, the critical point that you're raising or we're raising in this brainstorming session that we're having, Gary, is that we haven't followed prudent financial activity in the sense that you should always be operating with a margin of safety. The old margin of safety rule, and the margin of safety is more or less gone. Every place you look, there isn't any margin of safety. So that means that when things slow down, it's going to be more turbulent and more unstable than it would be if there were lots of margins of safety.
Agreed with that.
Now the one positive thing, actually, you went on you had a long list of negatives, but there is one positive, and that is you were going through kind of the income statement, the flow. But if you look at balance sheets, the stock, they're in pretty good shape. The balance sheet situation's in pretty good shape. So for everybody, for households, what they call households in the United States. Now, what does that mean? Well, that means maybe the margin of safety, that's the one bright margin of safety area is the balance sheets of households in the United States.
Possibly. The bottom, I would say the bottom of the K, though, the bottom 60 to 70%, their balance sheets aren't as pristine as the top 30%.
No, absolutely. No question about it.
So, we're already seeing, we're seeing we're seeing foreclosures or delinquencies at the highest rate since 2011. That's not a suggestion that balance sheets are looking great. We're seeing credit card balances at their all-time highs, and they're taking on credit card rates of like 20 to 23%. None of that suggests that their balance sheet looks wonderful.
Well, that's true. This is an important point that you're raising. So if you should never use averages, because what I said on average, the household balance sheet situation looks pretty bright, but there's always a distribution from high to low.
The top of the K looks fine. The bottom of the K does not.
And the top of the thing, just thinking it through. Let's just keep going here and thinking this thing through. We're running like this is like a discussion you'd have in a seminar at Johns Hopkins University if you were with me.
I would love it.
So what we're concluding here is that probably the average looks pretty good, but the average is skewed tremendously because the top has become very rich.
Exactly.
The pandemic, and we know the low didn't benefit at all. Their balance sheets didn't improve at all because why? Because the balance sheets they have. They probably were negative. They probably had a negative net.
Well, Steve, they're spending on things they must have with fiat that's declining in purchasing power.
Right.
So how could they have solid balance sheets?
So at any rate, you're speaking in both cases to two Dr. Dooms, right, as your listener.
I'm not being a Dr. Doom. What I'm trying to get to here is I'm trying to get to a place. What's the logical place that's going to cave? Is it going to be the Fed who's in a box? Is it going to be the government who's in a box? I mean, the personal consumer, the consumer who's in the bottom 60, 70%, they can't cave. They're just going to suffer the consequences. So when trouble really hits, right now we have this static flow in, they're spending a lot of extra money, the bottom of the K. They're spending a lot, because of inflation, and it's elevated and it's staying elevated. And so, their property taxes are going up, their cost of homes, their cost of living, their cost of eating out, their cost of putting their kids through school, all of that is elevating. They're maintaining their jobs though, so they're able to stay afloat, but all of their debt is increasing as well because of their cost of living increases. But if we start to have the trouble in the economy that you were referring to, if we see a slowdown, that means we're going to have layoffs. If we have layoffs, that means people who have no tolerance for risk whatsoever, nothing built into their budget, they're going to suffer hard. So if we have enough of those people suffering hard, 500,000, million, 5 million, whatever it is on the margin, there's going to be an outcry here. Something's going to need to be done. So is the Fed going to goose or try to goose? Is the government going to try to do something? Where's the logical relief valve that's going to take place?
Well, there isn't, because there really is no margin of safety if you look around. So you know, recession is always bad by definition. It's not good. And in this particular case, the government's finances are in terrible shape. Now, you asked a long time ago when we started this thing. You said, Hanke, what do you think about the deficits and debt? I mean, is that a problem? And so forth. Well, yeah, this now we're getting down to where the rubber meets the road, and it isn't economic theory on a blackboard. You know, the fact of the matter is, the government has driven into, shall we say, troubled waters. They don't really have any interesting or desirable options available to them, because they're already kind of, pressing the envelope. And if you look at the deficits, by the way, they're, by historical standards, the only time we've had a string of deficits like this has been when we were in World War II.
Yeah. Well, I guess then, with everybody being in a box and there's really no alternatives, I guess we just gotta hope that the business cycle is permanently broken, and we're just going to never have a recession again.
Well, yeah. Well, now you're getting into the praise zone.
I think a lot of people are going to end up in the prey zone at some point here in the near future. Well, look, normally we would move into our lightning round to talk about asset rankings, but we've gone over time, so we'll reserve that for the next time you and I chat. Steve, always wonderful time when you and I get together. I love the way you think. I love your brain. I love your responses. I love our discourse. It's a lot of fun. I would love to be out there at Johns Hopkins sometime in one of these type of.
Look, it's not that far from West Virginia. Get in the car and come over.
I might need to.
No, what we should do, I have an idea. You should drive over and we have a session at Johns Hopkins.
Like live?
Yeah.
Where I'm interviewing you live in front of your students?
You can interview me live. We'll get some of the students in. We can have a round robin. And
that would be a lot of fun.
Yeah. Let's think about that.
Okay.
You check with your producer.
Okay. Yeah. All right. Well, Steve, would you share with everybody who's tuning in something that you want them to keep in mind about today's economic, market, or monetary situation, whatever it is, and then let everybody know where they can learn all about your work, how they can connect with you, et cetera?
Okay. Money dominates. That's the main message. Now, where do you find out about this? I think you can obtain, and it's available on Amazon, every place, my new book, Making Money Work, that I co-authored with Matt Sekurki. So that's the heavy duty kind of thing. The more light duty is, you can follow me on X or Twitter at Steve_Hanke. And I've got, 800. Now I'm rated as the third most influential economist in the world with about 806,000 followers. So,
wow.
So there, some customers out there must like it. Otherwise, they wouldn't follow, I guess.
There's just something about you that they like.
Yeah.
That's awesome. That's wonderful. I'll have all that information up on the screen. Get me some of that information on your book. I'll put a cover.
I will.
Yeah, and I'll get some of that up on the screen and in the description area. So guys, you can click through and get over to Steve, get over to his book, etc. Steve, thank you so much for spending time with me, for coming on to Metals and Miners, for sharing all of your analysis and ideas. I look forward to having you back on sometime soon. Everybody else, thanks for watching.
See you, Gary. Thanks.